Something is shifting inside Canada's private lending landscape, and many investors are only starting to notice. But to understand what's happening today, we need to rewind a few years back to a very different financial environment. It was the era of cheap money. Interest rates were historically low, and many homeowners were able to borrow against their home equity at very attractive rates. At the same time, private mortgages and mortgage investment vehicles were often offering high single digit and sometimes double digit returns depending on the risk. On paper, the opportunity looked compelling. You borrow at a low rate, invest at a higher one, and capture the spread. But that spread was always a gross number. They never factored in the fees, the taxes, or the potential losses. And in a rising real estate market, fewer people stopped to ask what might happen if those conditions actually changed. Home equity began to feel less like long term wealth and more like accessible capital. Many investors moved money into lending strategies, believing they were generating relatively stable passive income. See, but passive income never means risk free. Today, the environment looks very different. Higher interest rates, tighter credit conditions, and softer property values in some segments have introduced new pressures into the system.